So let's just start off with James Gorman's comments. Obviously, he's a voice that the market pays attention to. He says he's not seeing any panic. Do you agree?
First, I don't believe the estimate of the E, the price to earnings ratio. When you think about what estimates are for 2023, they're only off its peak about 3 to 5%. And during any type of recessionary period, you normally see on average correction of peak to trough in earnings about 30%. In 2008, 2009, we saw 90%. And in 1980, we saw a negative 4.7%. So there is this wide range, right, Frank? However, when you think about what the Fed is embarking on, when you think about inflation, wages increasing, the pressures from inflation on companies, and this consumer demand slowing, you're going to see a profits recession, which means that if you take estimates down by 20%, and this is important, the forward multiple of the S&P today is 19 times. So that means the market has to get cheaper. That's why a lot of analysts out there are saying 3,000, 3,400 on the S&P. That's probably an appropriate level. So I'm not sure I really agree with Gorman is saying.
Wow, you've heard analysts say 3,000. Lowest I've heard is about 3,500, but that's certainly a very bearish call for 3,000. So one thing I want to touch on his comments a bit more. He said it's not 1981, it's not the dot-com bubble, but you say what we're seeing right now is very similar to March of 2020, obviously the start of the pandemic. So if we're seeing a very similar situation in March of 2020, should people still diversify their portfolio? Is 60-40 the way to go? How are you recommending that your clients set up their investments?
This is one of the most challenging environments that anybody's been in, right? Because balance and correlations of asset classes pretty much all came up together. So what I've been very vocal on the show numerous times is that we were in a bubble, it collapsed, whether it's technology, whether it's crypto. So raising of cash was important coming into 2022. So hopefully investors did that. So for my clients specifically, we have 15 to 20% cash, that with this downturn, we're going to be deploying capital. This is where you make the most money when it comes to investing. We're in a bear market. You got companies off its highs, 30%, 50% or greater. It's going to get worse, but you have to step in and dollar cost average into this storm.
All right, so your note actually hits on some of the themes that we're looking at today. You say right now we're basically in the eye of a storm, kind of playing off what we're seeing with Ian and the tragedy there. Obviously, the market's not as tragic, but still a lot of people losing a lot of their wealth right now. So we're in the eye of the storm. We're obviously seeing the stronger dollar as well. How does that impact your philosophy and your thesis going forward in the near term? I know you're a long-term investor, but at least in the near term.
Yeah, so what you have to understand is the first 20% correction or more that we just saw, that took a little bit of time, obviously. Well, here we are 9 months into the year. The next 20% is going to happen pretty quick, over a 2 or 3 month period. And that's when you really need to step up. You can't wait and wait things out over the next year or two to get back in until the light at the end of the tunnel is clear. It's this next drop is when you really need to step in. So over the next 2 to 3 month period, it's going to be time to deploy capital. That any studies that you look at, when you see corrections like we are seeing, 6 months, 1 year, 2 years, 3 years later, you'll be extremely happy that you stepped in. What you have to be doing as an investor every single day, Frank, is looking for opportunities of great businesses that are stable, that have good earnings, great free cash flow, and the market's throwing a perfect pitch at us, and we're going to get even a better pitch as markets get cheaper. So you have to step into that as an investor. This is where the most money is made.
All right, before we let you go, obviously PCE's coming up later. That's really been a market mover. When we see inflation take a step down, the markets seem to pop up. If it's higher than expected, we see a sell-off. What are you expecting later today, and how do you see it impacting the markets?
I've been extremely vocal about inflation the whole entire time, saying that it's not transitory. It was going to be out of control, as we're seeing right now. I think now inflation is going to be over. I think over the next 12 months, we are going to see inflation come down. You're going to see peak inflation, in my view, is already in. Look at the commodity prices. Look what the stock market's doing. Right, we saw a complete wealth effect evaporate, greater than 20, 30%. When you look at bonds, technology, and regular stocks. So the inflation story is going to start to dissipate just like COVID did over the next 12 months. That's my expectations of what we're going to see.